What we did in our reporting season preview was we said that there was a good chance of companies really beating pretty low expectations and earnings upgrades right through reporting season. And companies didn't disappoint. Across the ASX industrials, earnings were revised up around 2.6%. We also saw beat to miss ratio of about 2 to 1, or in fact over 2 to 1. And this is despite companies really getting hit late by Omicron as well. Remember in December, companies really getting hit there. And yet we didn't see too many earnings downgrades or trading updates during that period. So quite surprising, perhaps the strength that we've seen in that beat to miss ratio. And then also, if you look at the noise around inflation and costs, it's really easy to overlook some of the fundamentals. And with the market still in an upgraded cycle, where we're seeing there in that chart in the middle was 1.5 upgrades to every downgrade. And this wasn't just at the market aggregate level. We saw net positive revisions quite positively across the market. So that chart on the left-hand side gives you a good idea of where we saw the upgrades, and most notably energy, retail, media, banks, insurers, and even IT. So all were net positive EPS revision sectors. So I guess the issue was that the results did feel a lot worse than they probably were. If we just look at the performance of the market, excluding banks and resources, and this chart here shows you the market's actually down 16% year to date. Compare this to what EPS revisions have been doing, and they've been steadily increasing right through that reporting season period. And if you look at sort of how results reacted on the day, we saw 62% negative day one reactions, which dominated the positive reactions, about 38. Typically, we see that closer to 50-50. The average price reaction in the market was down 1%. So really, it's down to the picture around valuations, just how much you sort of pay for this market, something that the market has been obviously grappling with since Q4 last year. However, if you look at sort of what analyst price targets are, or where they're sitting relative to current prices, you can see there that there's plenty of upside. So certainly the analyst community post the results are indicating that there is plenty of upside here. So there's certainly some valuation support. Also, if you look at the 12-month forward PE of the industrials, it's now trading around sort of 20 times, and it's back at that sort of pre-COVID level. And arguably, the earnings outlook where we are now is much better than perhaps what they were sort of 2 years ago. So certainly we think there is some conservatism in that E. So while it may not feel like it, we certainly think the fundamentals will ultimately prevail over the course of the year. Why do we think this? Well, fewer than 22% of the ASX companies that we monitor have provided some form of quantitative guidance for FY22. So what that tells you is there's a wide margin for error across all of the sort of earnings risks that are surrounding the market at the moment. Also, that conservatism that I talked about, we saw 2.6% EPS revisions right through that reporting season period. It's only pricing in FY22 EPS growth of around 3%. So quite modest in terms of expectations, where we saw double-digit earnings growth over the last few years. Also, if you look at some of the trading updates post-reporting season from either the retailers, travel stocks, or even some of the gaming companies, shows you that there's a fair bit of momentum sort of coming out of this period post-Omicron as well. So we think also there are tentative signs that some of the risks around supply chain disruptions and workforce absenteeism is starting to abate. So we've heard from the likes of Amcor, GUD, Downer, Sims, all talking about raw material costs coming off slightly, the supply chain tightness just easing off somewhat. So there are some tentative signs there that maybe some of those supply chain pressures are starting to ease. And notably, I think here in this chart here is basically showing you what EPS revisions have done right through this COVID period over the last couple of years. And you can see there that we've been in pretty strong upgrade cycles. So typically Forecasts start off quite conservative and then subsequently revised up. This is different from the pre-COVID period where we saw downgrades through the years. So we're still seeing that. And if you look at forward looking forecasts of FY23 and 24, they remain quite conservative. And I point you to FY23, where forecasts for that year are only 10% higher than they were during the depths of COVID in August 2020. So, very modest in terms of earnings expectations for the outer years. So we certainly think there's upside to those numbers if economic conditions hold. And this is a chart that we like to show you sort of post-COVID, is that economic surprise index. And it shows you that the bounce back from each subsequent wave of COVID, the incoming economic data continues to surprise on the upside. And we're seeing that again during this period coming out of Omicron through that reporting season period, is incoming economic data continues to surprise economists' forecasts. So certainly some good signs there, and the fundamentals look reasonably sound coming out of reporting season. Obviously, it wasn't all good news. I mean, obviously supply chain tightness, bottlenecks around sort of labour as well. They remain an ongoing concern. And companies are tackling those challenges very differently. So some are, reverting to straight out cost out. Others are looking to premiumisation of their product. We've seen that with Treasury, REA, Tabcorp, even Coles talking about, using that private label higher margin business and growing that side of the business. So turning to that premiumisation mix. Obviously, the longer term implications, if inflation does hang around, is how sustainable some of these strategies are. So, what we do prefer in this market, where inflation has the potential to perhaps linger around a lot longer than what we currently anticipate, is that flight to quality. Companies that can afford to push prices back onto their customers with pricing power, dominant market positions. So, and we've seen that, with the Brambles, the Amcor, the Visas, maybe Buntings, the like, who have been able to push costs back. So we do think that cost out story will continue. We do think that inflation story to continue. So that's something to watch for. We go through a lot of the names that we think will hold up better in a price inflationary environment. And we've gone through that on page 10 of the notes. So Treasury, Corporate Travel, Coles, Endeavour, Lovisa, PWH, to name a few. But I might pass it over to Tom at this point just to talk through some of the other observations.
Just the scorecard you can see in the note, we can see that well over, or a bit over, a third of the entire cohort that we watch did beat expectations. And now that's partially a function of where those expectations were set, but even more so based on how strong the fundamentals of the Australian economy and of corporates in Australia actually are. So that beat rate was pretty much the strongest we've seen on record. The interesting thing from mine was that did not translate into sustained price performance, nor did it translate into upgraded expectations going forward. We actually saw the market overall on aggregate up 2.6% for 22. That's very modest. And the X100 stocks were actually downgraded in terms of their forecasts, despite their beat rate being the best that we've recorded. So that does show you that where the market is trading is not a problem with fundamentals. It's a problem with what investors are prepared to pay for stocks. And I think we can take some comfort out of that at the moment. Just talking about that market rotation and the psychology unfolding there, it really did begin in early to mid-January around looming tightening of financial conditions through the year, speculation on whether Fed's going to move at the mid-March meeting, and that could be a volatility trigger as those expectations unfold. But it's been characterised as a rotation from growth to value, and the tech stocks have been in the firing line on that trade, obviously, in the US. But I think what we saw through reporting season is that it's really a rotation to quality. So you can see that in the rotation to size. I think you can look at, interesting for mine, that the small industrials index in February performed as badly as the NASDAQ in Australia. And that's despite those forecasts for the X100 only being trimmed by a couple of percent. So you're looking at a 10 to 15% valuation de-rate in that part of the market, which is a function on what investors are prepared to pay. I think there's really good evidence that investors are really willing to look through this period. So you might think, yes, it's a rotation to value. It's not. It's size and it's quality. So you can see that in responses in some of the more expensive growth franchises in the market, the large cap stocks that did really well through results season, high PE names like CSL, Cochlear, TWE, Seek all did quite well. And you can even see it in the small to mid cap names that we do follow. We're looking at Lovisa, NextDC, ALQ, AP Eagers did well, corporate travel. So really fascinating for mine was that the Morgan's growth equity model portfolio actually outperformed the much more conservative the core portfolio in February by a number of bips. And it's strongly outperforming that portfolio month to date in March so far. And that's really driven by quality. Yes, at the large end, we've got names like ALQ, South 32 has been quite good, Westpac's been quite good, but also the market is prepared to pay for the emerging growth names still. Again, the same names, Lovisa, AP Eagers, NextDC, TNE and the like. So the media might characterise this as a flight to safety and a flight to value. I think it's a flight to quality, and that doesn't come at the full exclusion of our favourite growth names in the market. And I think it's a smart time to be looking through this noise and cherry picking some of those great names on weakness.